Do I think shares in Altria are still undervalued, and is the stock worth buying right now? Hey everybody, and welcome back to H Invests. So today we're going to be talking about Altria, a stock that has been getting a lot of attention in the investment community recently. It's a well-established cigarette company, but it also has a lot of exposure to the e-cigarette and cannabis markets. I did a full stock analysis on Altria about 6 weeks ago when it was yielding 8.4%, and a lot of people saw it as a great income generator that acted as a bond proxy and paid out investors a really good yield. But since then, the shares have gone up 30%. Now it's yielding 6.5% and it's getting a lot of attention. So, is Altria still a buy? Or has all of the upside been priced in? And is it time for investors that have made their money to take their profits and move on elsewhere? That's what we're going to be talking about today. I hope you guys enjoyed the video. Okay guys, so let's start off with analysing Altria's free cash flow. So effectively, let's start off up here. You can see Altria's free cash flow, how much they managed to generate each year. This is in millions of dollars. So in the most recent year, they managed to generate $8.2 billion in free cash flow. And what you can see is it's a pretty stable growth trend. We had a slight contraction in 2019, but then the free cash flow managed to grow by 3% in 2020. So that's what we've seen from Altria. And if you look at the analyst forecast, this is based off a sample of 17 analysts, looking at the average of what they think they're going to generate in terms of free cash flow in the future. What you see relatively stable with a slight decline. So if you annualize these out over the 3 years, you're getting a decline in free cash flow of 1.28% per year, which is quite interesting because over the past 5 years, they've managed to grow annualized at 21.88%. Which is quite interesting, although I do accept that most of this growth happened in this period, and from this period we have seen a slight decline. So that's what the average analysts are projecting. It's important to mention as well though that Altria, they do have a couple of tailwinds. They obviously have COVID, and with more people being at home on furlough, it's just been easier for people to smoke, so people have been smoking more. And then also they do have the growth opportunities with the e-cigarette market and the cannabis market with Cronos. So that's always something to consider. But analysts projecting minus 1.28 decline in free cash flow. And then the weighted average cost of capital, that came out at 6.4%, which is pretty low for a company. The reasons why you're seeing this is Altria is pretty financially healthy in terms of the balance sheet. That all look good. So they're able to borrow at relatively cheap rates. And also they have a very low beta. Like the tobacco sector, it has one of the lowest volatilities in the share price over the whole market. So that's why you're seeing a whack. If you kind of put these metrics into a 5-year free cash flow, with the free cash flow declining 1.28% a year, you get a present value of $55, which is just slightly above what Altria is trading at the moment. So 5% upside, nothing deeply undervalued, but it's looking like there's a small amount of upside from what the average analyst projects. What I like to do is I like to build these matrices as you see here. And what we're looking at here is if we're looking at the free cash flow grew at different rates and looking at different discount rates, what would our projected growth be? So I've kind of made this box of where I think the scenarios are most likely. So that's anywhere from 4% decline to 2% free cash flow growth. I put 4% decline just because obviously the analysts are thinking it's going to shrink. If the tobacco sector faces some headwinds, particularly from regulation or excise taxes as Biden comes in, then we could see 4% free cash flow decline. And then also, you know, I think it's roughly going to be between -2 and 0. It's a pretty stable business, but we might see a little bit of growth. So I put in +2% as well. And you can see here the range is that some of these are really undervalued, but most of the scenarios in the middle are looking slightly undervalued, but again, nothing impressive. If you average all of these scenarios out, you get an implied price of $63.58, which gives you 21% upside. So that's looking relatively good. But you have to remember that that is being pulled up by a couple of really, really healthy stats here. And there's also some in decline. So it's very, very difficult to say. I would conclude from this that Altria is still looking pretty cheap on a DCF perspective, but certainly not as cheap and undervalued as what it was looking like when the shares were trading at $40 back in January. If you're enjoying this video so far, please give it a like. It's really helping to push it out to more investors that might find my analysis useful. Okay, so now what we're going to do is we're going to look at Altria's earnings per share. We're going to look at what we might see from the price to earnings ratio going forward, and then multiply the two together and you get an implied price. So looking at Altria's past earnings per share, you can see it's been a pretty good uptrend for them on the whole. We saw a mountain of growth in 2017, followed by a bit of a decline in 2018, but since then 2018, 2019 has been pretty slow, steady, consistent growth. And that is what the analysts are forecasting in the future. So if you kind of annualize this growth out, you get an annualized growth of 5.78% per year over the next 5 years is what the analysts are expecting, which is quite interesting. So it's slightly lower than what we saw in the past 5 years, but still pretty good growth nonetheless, particularly from a cigarette company. It's interesting though, because obviously their free cash flow forecasts implied a 1% decline. So what does this mean if the earnings per share is still growing? Well, it means that analysts probably think that Altria is going to have to be spending more on capital expenditure, maybe because of their growth prospects in the e-cigarette and the cannabis industries. So maybe that's why we're going to see a good earnings per share growth, but then free cash flow growth declining by 1%. And then if you look at the price to earnings ratio, so I mean, pre-2016, the price to earning ratios of these tobacco firms were much higher before the whole kind of ESG ethical movement came in. But since then, we're seeing a PE in this range. And if you average these four out, don't worry about 2016. We're going to look at that as an outlier. Then you get an average PE of 14.2. And what does this mean? It means if you discount the earnings per share growth over these 5 years at this discount rate, which we saw in the last slide, and then multiply it by a price to earnings of 14.2, you get an implied share price of just shy of $59, where Altria is currently trading at $52.50. This implies 12% upside. So according to the analysts' earnings per share growth, it looks like Altria is slightly undervalued, but not a deep discount nonetheless. If you look at kind of what I think the forecast for Altria are going to be, I chose anywhere from 0 to 6% EPS growth. Why have I got 0 included in there? Just to be a conservative investor, right? Like, obviously, we're seeing the free cash flow be very, very stable and even decline a bit in recent years. And I know the analysts are saying 6%, and it has grown its earnings per share, but I wanted to include 0 just to be conservative because we're not really seeing the free cash flow growth. So anywhere from 0 all the way up to 6%, which is where the analysts are forecasting it. And then looking at the price to earnings, I think 8, 10, like it's too low. We just haven't seen Altria all the way down at those levels. And for such a stable company, it'd be quite unusual. But a PE of 12 is certainly possible. You know, we saw a PE of 12.8 in 2018, right after we saw like a big sell-off from these tobacco companies as the ESG movement really took hold. And then price to earnings of 14, that's probably the most likely because that's like the average range that we've been seeing over the past 4 years. But also 16 might be possible. You know, past 2 years it's been trading 15.2. It was trading down at 13, but obviously now the share price has gone up. It's trading more about the 15 range. So we might see a PE of 16 as well. So this is the kind of matrix that you see. If you average all of these out, it's a pretty similar story to the analysts. You know, implied share price of just shy of $56. At a current share price of 52.5, you're getting upside of 6%. So again, similar with the free cash flow, it's looking like Altria is a little bit undervalued, looking at the forecasted earnings per share and price to earnings, but it's not trading at a deep discount at the moment. Okay, so I also thought it was really important to talk about Altria's dividend. Why is that? Because obviously most people are buying shares in Altria for income, right? They're not buying shares in Altria because they think the tobacco market is going to catapult and it's going to grow 500% over the next 5 years. They want it for good, stable, high-yielding payments. So, if we look at Altria's dividend history, you can see relatively good growth in the dividends. They did have quite a big cut in 2013, but then you'll notice in 2014 they almost brought it back to the same level as we did in 2013, and since then they've grown it pretty consistently. The analysts, again, they're forecasting dividend growth in the future in the range of 5 to 6%, which is not quite the level that we saw in the past, but it's still good dividend growth nonetheless. And this is supported by what Altria's management's opinion is on the dividend. So they're basically saying, we want to have a targeted dividend payout ratio of 80%, and they're currently at about 75%, and they're also going to be able to grow their earnings per share. So this means they're going to look to continue to grow their dividend in the future in order to get to that 80% target payout ratio. And now here's the important thing. So if we look at the yield, so what I did was I added up last year's dividend payments, and now we look at what yield would you get, and then what implied share price would that be. So at 8% yield, the shares will be trading at 43. At 7% yield, the shares will be trading at 49, and so on and so forth. And where's the region where income investors, all of a sudden, they're not so interested, and we might see some resistance in the share price? And personally, I think it's in the region of 5 to 6%. We saw 8%, 8.5% from Altria, and that generated a lot of interest. And now the market has bid up the shares a lot because they just said, hey, this is 8% yield. It's stable yield. It's in a stable market. Tobacco is a very kind of predictable and stable industry. Let's go and buy these shares. And that pushed up the price. But I think we will start to see a lot of resistance, particularly if we get up to 5%. I don't think income investors are going to be as interested anymore. You have to bear in mind that the average yielding stock in the S&P 500 is only 1.4% at the moment, which is very interesting. And Altria is currently 5th or 6th in terms of yield, but they just have it so well, and they're covered by free cash flow. They're in a very stable, predictable business, you know, with slow, consistent growth. But I think we'll see in the region of 5 to 6% dividend yield. I think above 5%, as I said. I don't think the market will kind of reward it as an income stock and keep bidding up the share price. So if you average these out, if you say 5.5%, that gives an implied share price of just shy of $63. And finally, I wanted to have a look at some of the sell-side consensus and what their price targets are. So you can see here we have some different brokers. Morningstar think the shares are slightly undervalued. Same with Deutsche Bank, and Jefferies think they're quite undervalued. But on the whole, the consensus is the shares are about fair value. You have CFRA saying they're really overvalued. Citi think they're overvalued. And the consensus, when you average it all out, you get a target price of 50. So that's about 4% downside in the current share price. So you can see that analysts, they're not actually that bullish on Altria anymore, or a lot of these target prices, you know, 54, even 46, like they were quite bullish when Altria was trading at 40. But now a lot of that upside has been realized, and there's not that much upside left if you bought the shares now. However, I will say that I did notice a lot of these price targets were revised. So Jefferies, this price target went all the way from $40 up to 58 very, very recently. Same with Deutsche Bank. This should actually be $56. They revised their target price from 54 to 56. So we're actually seeing some analysts actually revise their share price as they see the positive momentum in Altria, and it might be a stock that they haven't really thought about for a long time, and they think, oh, hey, there might be some opportunity here. They redo all of their valuation models, and they actually come up with a higher price target. So that's just something to bear in mind, is that yes, these price targets, some of them are bullish, some of them are bearish, but I'd definitely say take them with a pinch of salt, because a lot of them have changed quite a lot recently. Okay, so in conclusion, do I think shares in Altria are still undervalued, and is the stock worth buying right now? The answer is, it looks like a lot of the upside has been priced in, and it's not a clear-cut decision on whether it's a good time to buy or not. It really depends on which kind of valuation model you use, what you think of the momentum in the stock right now, and whether you're investing more for income or whether you're investing because you think the market is underappreciating any future growth that Altria may have. If you look at my discounted cash flow valuations, there was a really wide range in where I think the shares could be worth, but the average came out at about 21% upside. When we looked at the EPS, that was a little bit of a smaller range, and the average came out at about 6% upside, which I would say is roughly fair value. If you look at the dividend yield, I think there's a lot of upside there. I think with a yield of 6.5%, that certainly makes the shares very attractive from an income perspective. And I think that there could be a good opportunity to go in and buy Altria for income. If the market wants high yielding stocks, Altria will continue to be bid up. If they get bid up to 5.5% yield, then the shares currently have 19% upside. And lastly, if you're looking at what the analysts say on average, Altria is looking about fair value right now, although there were a couple of analysts revising their price targets higher and higher. As we saw Altria shares increase in price, it seemed to have piqued their interest a little bit, and they seem to go, oh, hang on a minute, Altria might still be a deal. So that's the conclusion. With regards to what I'm doing, I did hold a large proportion of shares in Altria, and I think what I'm going to do is slowly kind of sell off the position. I might sell some covered calls with slightly higher strikes than the market price, and then kind of like slowly wind down the position. It's past its last ex-dividend date on the 24th of March, so anybody who owned the stock on that date would qualify for the next dividend, so I'm not too worried about any future dividend payments now I have that one in the bag. I hope you guys found my analysis on Altria useful. Let me know any questions you have in the comments, and until next time, happy investing.